Today we're joined by Larry Swedroe, CBS MoneyWatch blogger extraordinaire and the author of The Quest for Alpha, a new book about passive investing. Now, passive investing, maybe not the world's greatest marketing name. It sounds like doing nothing, but your book makes the point that it's not that at all.
And that's correct. Most people think it means buy and hold and do nothing. What passive investing to me means is you're doing the opposite of active investors. Active investors are trying to manage returns, while passive investors simply passively accept whatever returns the market gives them in the asset classes in which they invest. So first of all, you have a well thought out plan. It may include investing, say, 50% of your equities in US and 50% international. So it's not just an S&P 500 index fund. And you may want to split your US into small and large, value and growth, real estate. Similarly, internationally, large, small, value growth, adding emerging markets. Maybe you want to add a little bit of commodities or gold, whatever. So you may have 10 different funds that are all passively managed, but it doesn't mean do nothing. When the market moves, just to keep it simple, if we had 10 funds, we might put 10% in each. Well, the next day or the next month, you've got 12% in one and 8% in the other. You want to rebalance on a regular basis. So you're controlling the amount of risk in the portfolio, not letting the market do it for you.
When you're an active investor, you're trying to manage returns.
That's right.
When you're a passive investor, you're managing your risk.
That's exactly
that's something
the difference.
you can control.
That's right. I think the biggest mistake of active managers is they try to manage returns, which is the one thing nobody can do. There's only one person, I like to say, who knows where the market's going, and I won't get to speak to him in this lifetime, and the next one, it won't do me any good anyway. So I think the key to investing is to focus on the things you actually can control. The amount of risks you take, making sure you don't take more risks than you have the ability, willingness, or need to take. What types of risks you take, how much small in value in emerging markets, and treasury bonds versus junk bonds, or whatever is appropriate for you. And then diversifying those risks as much as possible, getting rid of the idiosyncratic or unique risks of individual stocks, okay, and asset classes. So you want to diversify across them. You want to focus on keeping costs very low, not necessarily minimizing them, because some funds can have a little higher costs, but can deliver more value through securities lending or tax management, et cetera. And lastly, you want to focus on managing for tax efficiency. Again, not necessarily paying the least amount of taxes, but generating the highest after-tax returns. And there are funds that aren't index funds. Dimensional fund advisors, for example, run some tax-managed passive funds that harvest losses and will never take intentional short-term gains. So those are the things that you focus on. Doesn't mean you're passive in regards to the portfolio. It only means you're passive in regards to the market. That's a huge difference.
Larry, thanks. That was very interesting, as always.
My pleasure.
And thanks for watching.